My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses.
The Federal Reserve raising interest rates by 3/4 of a point today. Again, this is the third time this year the Fed has raised rates in an effort to control inflation.
Core inflation outside of energy and food prices has remained above 3%. That is higher than the Fed's 2% benchmark. Financial advisor George Noceti from Morgan Stanley is joining us now. George, thanks for being here. We knew this was coming. It's not the first time it's happened. Not going to be the last time. They're going to keep doing it. Is it working?
Well, I'm glad you're reading the tea leaves, because the Federal Reserve has been telling us they're going to do whatever they can to get this inflation down. And so what they did today is they hit us with a sledgehammer again, 75 basis points. We've had 3 of these now. This is the most we've ever had in the history of the Federal Reserve. They're planning one again next month, and they're going to probably end up the year at about 4.4%. And this is the rate that they lend to banks. And of course, you know, Ken and Pam, we go to the banks and we want to get a mortgage. That's going to cost us more. A home equity line, that's going to cost us more. If we have credit card debt, that's going to cost us more. We're going to feel the pain for quite a while. And that's why the market started off positive in the morning. Feds came out with a 75 basis point hike. The market realized the effect. They realized the Federal Reserve, again, is very serious. And so it's just going to cost us more for a period of time until we get this core inflation down where it's supposed to be.
George, explain, you know, in elementary terms, for me as much as anybody else, how prices, keeping the rates high helps bring inflation down, especially because some of the essentials that are high, like food and rent, are things that people cannot, there's no give and take there. They have to pay those rates.
Well, at some point, things are going to be too expensive for you to buy, and you're going to stop buying. And so companies also have to borrow, and that's going to cause them, because they want to get more profitability, to perhaps lay off some people. And when people are laid off, they're not spending. Those kind of factors, I mean, it'll permeate through the entire system, where it'll start to get things lower because people will stop buying. Right now, Pam, people have a lot of savings, and they've been able to buy, and they've been able to chase, you know, fewer products, which means that they're going to cost more. Inflation, the Fed wants everybody to kind of stop, pull back, and that's very painful for a lot of people, especially those people, Pam, that are on fixed income and get a fixed salary, and now they have to pay more for food, pay more for gas, pay more for lumber, pay more for do-it-yourself things that they're using to fix up their own apartments and houses. And also, because it's really hit the housing industry a lot, people can't afford houses, so now they're moving into apartments, and because there's fewer apartments demand is high. And so those monthly rental payments people have to pay are also going up high. So it's hitting everybody, you know, pretty hard right now.
One of the interesting side stories to this whole thing is how the United States fits into the international community on inflation. Our inflation isn't as bad as some other countries, and the dollar is very strong right now. If you're going to travel overseas, you're going to get more bang for your buck. Talk about that, and does that have any meaning here in the U.S. compared to what's going on in other countries?
Well, if you have the resources to travel, yeah, you're going to get a great discount. But if you don't have the resources, you're not going to benefit from that. So it's really going to hurt our dollar that has really gotten stronger, is really going to hurt us in terms of our exports. Our things are going to be just too expensive to buy. But you know what? A silver lining in this whole thing is that fixed income is actually paying us something now. You know, with your passbook accounts, I mean, in some banks, even in Morgan Stanley, we're paying about 2.15% just for cash, and that's going to probably go up again, you know, tomorrow. And the 4-year Treasury is paying in the range of 4%. You're actually getting something for fixed income, whereas for the past 10 years, you haven't gotten anything. So, you know, CDs are paying more. So there is a bright side to it for people that just have cash. And we should be in a lot of cash right now on the sidelines, waiting for this market to really bottom, and then be ready to put money in when it moves up again.
So more savings is good, even though you're saying that people are spending from that savings, and the Fed doesn't really want them to do that. You know, it's a complicated formula to have people understand it. Nonetheless, regular people are already kind of cut to the bone on what they are able to spend for just basic things like, as we've said, food, gas, energy, rent. What do you say to them?
Well, what I say to them is, if they're on fixed income and inflation is really hitting them because they have a dollar but now things are costing them $1.02. Then they have to really go back and they really have to look at where they're spending their money and only spend it on those things that they need. And maybe they're going to have to really limit their wants for a period of time until the economy, gets a lot better. But a lot of people have a little bit of savings, a little bit of cash, and they can put it into a CD now and get a little bit of return. Some of the banks are actually paying a little bit for holding cash right now because the Federal Reserve is, and that hadn't happened for the past 10 years. So that could be a place for people to, put their money. But again, people on a fixed income, they got to really cut back. They really have to cut back on their spending and only spend it on their needs and really limit what their wants are. That's painful to say. It's hard to do. But in difficult times like this, you do have to do some things that are painful. In fact, those people, Pam, that have any kind of credit card debt, credit cards are ridiculously expensive. And every time the Fed raises the rates, the credit card rates go up immediately. And so people have to either pay off that, and if they don't have the resources to do that, they really need to search the environment on the web for banks that will pay lower credit card rates, and they're out there, and they can save. That's one of the ways to help with their cash flow. Don't eat out as much. Eat at home. Even grow your own vegetables. We do that. I mean, it's a good thing to do that. So if you really start looking, you can find ways to cut back. But it's not easy. It's painful, but it's just a period of time that we have to get through it. If we let this inflation grow rampant, we're going to have a deep problem for a long period of time. So the Fed has to take aggressive action. And the market has to understand that and reflect its stock prices, in that regard.
So the last report, inflation was over 9%. How much longer do you think we are going to go through this period? And when are we going to get to what the Fed finds as an acceptable inflation rate?
Well, the Federal Reserve has come out and said they think that inflation could be down. This is now not headline inflation, but core inflation, the kind of things that you and I spend our money on mainly. They think it'll be down to about the 5% range. But we really don't see inflation. I mean, it's pretty deep, and it really got out of control, and we fed it with a lot of liquidity, so there's still a lot of cash on hand. So we're going to have to go through this year and probably next year to get it down. It won't be really till the following year. In fact, we're really not seeing the Federal Reserve lower their rates until about 2025. They should be at about 3.6%. So it's going to be really, really tough to get to the 2% range. But look, take the Federal Reserve seriously. They're going to move on this quickly to try to get this inflation rate down so we can get back to some normalcy going forward for everybody.
So are we still talking about a recession?
I don't like to use that word because it's different this time around. In the 70s, Pam, we had double-digit, really high inflation. We had huge jobless claims. We were not energy independent. All that is not true anymore. All that's very, very positive. So we have a lot of strength to weather this. It just depends how quickly we can get this inflation rate down. So, it's about a 50-50 call, I think, realistically, on a real technical recession. But it will probably see more of an economic slowdown unless the Fed is not successful at getting these interest rates down.
All right. George Noceti from Morgan Stanley. Thanks, as always, for helping us understand what's going on out there. Appreciate it.
Pam and Ken, it was a pleasure. Thank you.